You've heard this a million times, right? I mean, it's practically the first rule they teach you in Personal Finance 101. Buy a home, build that equity, lock down your future. It's the absolute cornerstone of the American dream. But what if that's all wrong? What if the single biggest financial move you're told to make your entire life is actually a trap? One that's designed to drain your wealth instead of building it? Well, today, we're going to do a full forensic audit on the dream home. Okay, so to really get to the bottom of this, we have to start at square one. We've got to get our definition straight. And it all begins with understanding what an asset and a liability truly are in the simplest terms you can imagine. Forget all the complicated jargon from your economics textbook. It really just boils down to this. An asset, it puts money into your pocket. Simple. Think of a rental property that's generating cash every month, or stocks that pay you dividends. Now a liability, it does the opposite. It takes money out of your pocket. You know, like a car payment or that credit card bill. Cash flow is everything here. So let's apply that super simple rule to your home. Every single month, money is flowing out. You've got the mortgage payment, property taxes, insurance, all of the upkeep. It's not putting cash in your pocket, it is taking it out consistently. Which leads to a kind of harsh realization. For the 15 or 30 years you're paying that mortgage, you're not really an owner. You're essentially just renting from the bank. But here's the thing, that mortgage payment, that's just the tip of the iceberg. The real story and the real hit to your wallet is hidden in all the numbers that nobody ever includes in the glossy sales brochure. And that brings us to the hidden mouth of homeownership. We like to call these phantom costs, and they're exactly what they sound like. They're all those ongoing expenses that just sneak up on you. They're these silent cash flow killers that can turn what seems like a manageable mortgage into a real financial burden. And trust me, they are constant, they are very real, and man, do they add up fast. So what exactly are we talking about here? Well, you've got property taxes, which, let's be honest, only ever seem to go up. You've got HOA fees for community services you may or may not even use. There's the constant cost of lawn care to keep up with the neighbors. And then there are the big ones, the surprise $10,000 roof replacement, or the AC unit that just has to die in the middle of July. These aren't just one-time hiccups, they're the price of admission to the Homeownership Club. All right, to really see how this plays out, let's run a little experiment. Let's imagine two guys, both named Bob, on two totally different paths. Homeowner Bob buys his dream house. He's paying his mortgage plus all of those sneaky phantom costs we just talked about. Meanwhile, renter Bob gets a similar place, but his monthly rent is less than Bob's total homeownership costs. Now here's the absolute key. Renter Bob takes that difference in cost and he invests it every single month for 30 straight years. So fast forward 3 decades. What's the result? It's honestly staggering. Homeowner Bob, sure, he owns his house, probably has some equity built up, but renter Bob, by just investing that leftover cash, he let the magic of compounding do its work. And he's built a net worth that completely, utterly dwarfs what Homeowner Bob has. It's not even close. Let's just put a number on it. Take a second and just let that sink in. This isn't just some random figure. It represents the opportunity cost. It's the potential mountain of wealth that was eaten up by homeownership instead of being put to work, growing in the market. This is the hidden price tag of the dream. But you know, the cost isn't just about dollars and cents. There's a really powerful psychological trap that comes along with buying a new home. It's a trap that kicks off a whole new and very expensive cycle of spending. It's a phenomenon called the Diderot Effect. And the basic idea is that when we get one new, shiny thing, it suddenly makes all of our old stuff look, well, kind of old and shabby. This creates this nagging internal pressure to upgrade everything else just to match that new possession. It creates a spiral of consumption. And a house is the ultimate trigger for this effect. You see how it works? First, you buy the beautiful new house, but then all of a sudden, your old college couch just looks awful in that perfect new living room. So you buy new furniture. But now the sleek new furniture makes the kitchen cabinets look dated and tired. And before you even know what's happening, you're pricing out a full-blown renovation. It's a chain reaction of cost, and it was all kicked off by the house itself. So after digging into the phantom costs and these psychological spending traps, we've got to circle all the way back to our original question and look at it through a whole new lens. Now, let's be absolutely clear here. This is not about saying you should never buy a home or that homeownership is bad. The real takeaway here is about a fundamental shift in perspective. Maybe, just maybe, the primary value of a home isn't as a financial investment. Maybe its real value is in the stability, the comfort, and the joy it brings as a place to live your life, to raise a family, to make memories. Which leaves us with this final crucial question. When you really factor in everything, the mortgage, all those phantom costs, the Diderot effect, are you actually buying a financial asset? Or are you just paying for a very expensive long-term subscription service for a place to live? How you answer that for yourself might just change your entire financial future.